I just wanted to thank everyone who's attending the webinar today. Thank you so much for your time. This is something that the three of us have been really looking forward to because it's definitely something that's a passion of ours and one of our favorite things to talk about and plan for. We love talking about charitable giving, donor advised funds, private foundations, and really we've been so blessed to work with so many generous families over the years. One of my favorite quotes is, it says, most people think that Americans are generous because we're rich, but the truth of the matter is we are rich in significant part because we are generous. And that's really been our experience with everyone we've been working for. We've been so fortunate to work with so many generous people here in Tulsa, Oklahoma, and across the country. So we're excited to be here today. I'm Jennifer Kohlbacher, and I'm one of the tax directors at Mariner Wealth Advisor. I've had the privilege of working with a lot of nonprofits and private foundations over my career. I'm joined here with Mike McAndrews and Kathie Coyle. Mike is one of our tax wealth advisors, wealth directors here at Mariner Wealth Advisors, and he works with a number of high net worth individuals and families, business owners, coming up with a range of financial planning and solutions for them. And Kathie Coyle joins us. She is an attorney here in the area and does a lot of estate planning and works a lot with tax-exempt organizations. She assists so many clients with charitable planning, charitable trusts, private foundations. Both her and Mike offer a wealth of knowledge, but they both also serve on a lot of boards and have worked in the community and with a lot of non-for-profits as well. So really a wealth of experience that they're adding. I wanted to let everyone know that we wanted to make this as interactive as possible today. So we do have a question and answer box that we're watching. So all of you should have access to that. So please feel free to submit questions throughout the webinar. We're going to leave some time throughout the presentation that we can discuss those. So don't be bashful about sending those. Mike, I'm kind of going to start with you today with our discussion. We've worked together with a lot of families, and one thing that comes up quite a bit is, we're interested in starting some charitable giving, some planning, and we're trying to understand what the right approach is, what works with our family, with our goals, with our financial plan. Can you kind of walk us through how this kind of conversation typically starts coming up?
Well, I was just thinking in preparation for this discussion, it's several different tracks can lead us to the same place. And, first and foremost, generally, the case is there's a charitable inclination with the individual or the family that we're working with. So there's generally that thread is there. That may not be what triggers them to decide to take the jump to either have a donor advised fund or establish a private foundation. But that's the underlying thread, I think. Oftentimes there's kind of two, I'd call triggering events that usually kick us into action mode. One is just looking for a tax offset. I would rather be able to direct the dollars that I'm going to have to give to organizations in need that I want to support rather than giving it to the government and hoping that it happens. The other is maybe they were fortunate to have some sort of a liquidity event. Who knows what the source of that is, but that family, that individual came into some new wealth, and that may be coupled with looking for a tax offset, or it could be they just want to share some of the benefit they've received. So, those tend to be the driving factors. Then you get into the decision factor of, oh gosh, well, now I've got to get into deciding what route do I go. And that clicks into a whole different conversation, which is really kind of a personal preference. And it's what feels best to you. I know we'll get into more about what's the difference in, and how do you compare a donor advised fund approach from a private foundation approach. But it really has to do with, a lot of it is how much interaction do you want to have? Is it a level of ownership? Or is it something I want to have a vehicle where it's easy for me to give, and I'm going to, just kind of go that route. So kind of a level of ownership versus a transactional approach to it. I also think, and I think Kathie will get into this more, but there's also a privacy element,
Right.
where, a donor advised fund, you can name it whatever you want. You're sitting behind, you know, uh, some entity that is managing that for you, and you are completely as anonymous as you want to be. Whereas in a private foundation, there's a bit more public disclosure, um, associated with that.
Right.
So, I mean, we've kind of hinted around these different, different charitable giving vehicles. Maybe it's a good place to take a few minutes and say, okay, let's look at these, and provide some definition around what they are.
Sure. And I'm hoping everyone can see, we've put together, this will be kind of the only slide that you'll see during the presentation, as we wanted to make this conversational, but we thought this was a good visual of just some of the basic differences between a donor advised fund and a private foundation. And we'll dig into some of these more throughout the presentation, but I wanted to kind of give you a little bit of a high level when we start the conversation off, as Mike mentioned, of some of the things that we start talking through. Different things as when does it need to be set up and what kind of lead time do you need. Donor advised funds are almost as easy as a flip of a switch. I mean, there's a little bit that goes into it, but it is a pretty immediate, something that can happen pretty quickly. Where with a private foundation, as we're setting that up, it can definitely take a few weeks and months to get the documents and everything executed and set up. Donor advised fund, again, along with the ease of it, it's just pretty cheap to set up, and on an ongoing basis, pretty low administration fees, where a private foundation can be a little bit more fees up front and some ongoing investments. There's also some tax contribution differences. When you contribute cash to a donor advised fund, you can deduct up to 60% of your adjusted gross income currently. When you contribute to a private foundation, it's limited to 30% of your adjusted gross income. So it's just something to be mindful of. Both of them can accept stock or other types of assets. And again, we'll get into some of that. And then we run into a little bit of different income thresholds. Whenever you put stock or other assets in there, they both go into either a donor advised fund or a private foundation at a fair market value. So you do get the tax deduction at that. With a donor advised fund, there's no timeline that you have to redistribute those funds out to charity. And one of the things that we're going to talk about is that there is an annual requirement with private foundations to give away a piece of the investments or cash that is in the foundation throughout the year, normally around 5%. There's also a excise tax on the investment income in a private foundation. Now, it's an extremely low rate, but there is a little bit of tax, and there are tax returns that need to be filed. And then, as Mike mentioned, just there's some privacy with a donor advised fund. You can keep it pretty confidential, whereas with a private foundation, similar to a nonprofit, there are certain things that will be shared publicly and are made available to the public. So there's just some certain things to keep in mind, and usually we kind of start talking through this when we start looking at what to do and what's best for each individual client. Now, Kathie, do you kind of want to walk us through, as we're talking about planning and setting up, kind of some things to think about whenever we're setting private foundation up?
Sure, I would be happy to. And I know people, wonder sometimes whether a donor advised fund is better or a private foundation is better. And there's no right or wrong answer to that. And a lot of clients find that they would like to have both a private foundation and a donor advised fund. So they're not mutually exclusive at all. A donor advised fund is sort of like an investment account that can only be used for charitable purposes. And in 2018, donor advised funds held over $120 billion. So a donor transfers assets to the donor advised fund, and that transfer is irrevocable. The donor advised fund is in control, but the donor advised fund wants to stay in business. So normally they will always honor the donor's wishes. The donor can advise it what charities it wants to support, and the donor advised fund will make those contributions. The donor advised fund invests in funds, does the investment allocations, does all the administrative hassles, does due diligence to make sure that the charities are officially recognized by the IRS, sends acknowledgement letters, keeps the donations anonymous, as you all mentioned, if you choose, and takes care of any tax information that needs to be provided to the IRS. There are essentially two types of donor advised funds. There's the community foundation, like the Tulsa Community Foundation, and then there are the for-profit custodians, the commercial donor advised funds. These donor advised funds are very streamlined. But I mentioned sort of an interesting case that went to a bench trial a couple of weeks ago in California that shows that sometimes things can go awry. There was a family named the Fairbairns, and they had a company, Energus Corporation, and this was in 2017. They had over $200 million in income that year. So they were looking for a charitable contribution, and they worked with a commercial donor advised fund to contribute $66 million to the donor advised fund, with the understanding that the donor advised fund would not sell all the stock too quickly and flood the market and depress the price. Well, I guess there was a difference of opinion, but anyway, instead of a $66 million donor advised fund, they ended up with a $41 million donor advised fund. And so they are suing the commercial entity for not honoring their wishes. But as I said, once you don't make the donation, it is irrevocable. And unfortunately, as I understand it, in this case, nothing was in writing. But there is a movement, it hasn't gone very far, very fast, to impose some of the private foundation restrictions that are on private foundations to donor advised funds. So we just need to watch that. But private foundations, on the other hand, are legal entities that are established by individuals, families, or businesses. State law governs the initial setup, whether the private foundation is a charitable trust, which is subject to the trust rules, or whether it's a not-for-profit corporation, which would be governed by the state's General Corporation Act. At this juncture, there are no LLC private foundations because that would involve an ownership capacity, and charities really don't have owners. There are several uniform acts, like the Uniform Trust Act and the Uniform Model Nonprofit Corporation Act, that Oklahoma has not adopted. But if you're in a different state, you would need to check to see what the rules are. There's no real definition in the Internal Revenue Code for a private foundation, but generally they are charitable entities where funding comes from one source, a family, a business, an individual, that relies on investment income and makes distributions to other charitable organizations rather than operate its own program. There are private operating foundations, but we're not going to talk about those today. A trust form is probably a little bit simpler. It's very efficient for a small family. governed by the charitable trust rules. You can have trustees can be for life. In Oklahoma, if you get into litigation, the Attorney General is entitled to any notice that involves a charitable trust. A corporation files a certificate of incorporation with the Secretary of State and is subject to the corporate governance requirements, such as bylaws, consents, minutes, although even with charitable trusts, we recommend that the trustees keep minutes of what they do. Oklahoma statutes provide protection from liability from most acts. You're subject to the business judgment rule. Directors, trustees usually have terms. And you may recall when Sarbanes-Oxley came down, some of those requirements are imposed on nonprofit corporations as well as for-profit corporations. So, you know, you'll want to have document retention and whistleblower policies. And with either form, you know, we always recommend that you have a conflicts of interest policy, a mission statement, an investment policy. And as Jennifer and Mike pointed out, whatever form you take, they will file a Form 990 PF annually. So I love to set up private foundations. You know, these entities can provide a family legacy. Children and grandchildren can be involved, family bonding experiences. They can, patriarchs and matriarchs can inculcate family values into generations. But all of these people in the family, as well as some managers, are considered disqualified persons, and there are many laws that apply to them and prohibit many transactions among them. And the tax penalties for violating these rules are absolutely confiscatory. So private foundations can be wonderful, but they can be costly, time-consuming, and administratively burdensome. So there's certain laws that for private foundations that Mike and Jennifer just alluded to. I'll just go through them real quick. And these all emanate from the 1969 Tax Reform Act. And that was a long time ago, but at that time, Congress was looking into very wealthy families who were donating their family stock to a private foundation. They were getting the charitable deduction for it, and they were still voting the stock, but the stock was sort of sitting in the private foundation, and it lots of times was not paying a very big dividend. So money was not really getting out to the hospitals and the universities and the museums and the social service organizations. So Congress came up with this Tax Reform Act in 1969. And one of the first things they required was that each private foundation is required to distribute an amount equal to approximately 5% of the value of its non-charitable assets. And it's a formula because you can take some administrative expenses against this. But when you do your 990 PF, there's a line on page 8 or page 11 that says exactly how much you need to distribute the next year. Congress also imposed self-dealing rules. So directors, trustees, managers, family members, these disqualified persons that I mentioned, are all subject to, there are no financial transactions between these entities, no sales or exchanges, leases, loans, furnishing goods or services. You just can't do that. So you cannot sell your beautiful painting to your private foundation. You just can't do that. So a few years ago, the concept of intermediate sanctions was introduced, which focus on compensations paid by nonprofits. And if you pay reasonable compensation for jobs that are actually done, that is okay.
Right.
The best practices would, if you're just a trustee of your family foundation, and you don't really do anything but go to a meeting once a year to distribute the money, best practices say you really should not take a trustee's fee for that. But if you're the executive director of the foundation, you're doing site visits, you're administering grants, you're interacting with the community, it's okay to take reasonable compensation for that. And the Council on Foundations, Exponent Philanthropy, the Conference of Southwest Foundation, all have comparables for what would be a reasonable salary for the size of your foundation, the area of the country where you are, and the job description. And sometimes foundations will permit a trustee to have some discretionary funds where they can distribute, you know, $5,000, $10,000 to any charitable organizations that they want, even if it doesn't comply with the mission of the foundation. The excess business holdings, private foundations really may not hold more than 20% or sometimes 35% of a business, but the Bipartisan Budget Act of 2018 included the Philanthropic Enterprise Act of 2017, which allowed Paul Newman and Newman's own salad dressing and pasta sauces to all be held by his private foundation. Apparently, Newman's own had distributed something like $500 million over the past 30 years or so. And so the Connecticut legislators had lobbied for this for a long time, and they finally were successful. So you can give your complete business to your foundation, and there are a lot of rules that surround it, but it is possible to do that now. Foundations were not supposed to invest in jeopardizing investments. So no Bolivian silver mines, but with program-related investments and mission-related investments these days, those lines are blurred a little bit because you can invest in deteriorating neighborhoods, even though some people might consider that that's a jeopardy investment. The taxable expenditure rules place limitations on the types of grants a private foundation can make with regard to legislative activities, grants to individuals, and grants to non-charitable organizations. But sometimes you can exercise expenditure responsibility and make grants to those kinds of organizations. The private foundations, as Jennifer and mentioned, that are subject to an excise tax. Nonprofits and charities do not pay an income tax, but this is an investment tax. And it was changed this year to just be a regular 1.39%. It used to go back and forth. Private foundations are subject to UBIT, like working interest in oil and gas interests. But the rules are onerous sometimes, but private foundations are wonderful. But when you plan for them, you need to figure out what you want to do at the end. Do you want your private foundation to last forever, a perpetual? Do you want it to last for a few generations, for maybe the generations that you know about, the grandchildren that you're familiar with? What I'm seeing more and more, and I'd be interested on the what others take, is that people are coming back in and saying, when my grandchildren die, I'd really like my private foundation to be terminated into a donor advised fund, which sort of brings us back full circle to where I started. So, thanks.
Well, maybe now it's a good time to kind of talk about, okay, so we've set this thing up, or we've gone one route or the other. One clearly has a lot more hurdles and challenges that you have to be mindful of as you move forward. But, you know, maybe it's a good time to say, okay, you've set one up, you've made this decision now, what does life look like?
Right.
And, you know, a good place, let's start with the easy case, because that's a donor advised fund. And essentially you put the resources in the hands of a custodian. Could be a community foundation, could be a for-profit custodian. Either is going to perform in very similar ways. I mean, basically, as the original contributor, you have the ability to basically request, but they're going to honor them, you know, giving and contributions to different charitable organizations. As long as they're a 501c3, we've never run into any cases where, you know, a donation has not been made. Sometimes they have to be set up on the system. If it's a smaller one that may not be, you know, as well known or set up everywhere, but we've had good success with that happening. From an investment standpoint, there's kind of different rules depending upon where you are. I know for certain with the for-profit custodians, generally, if you're somewhere between 200 to 250,000 in the donor-advised fund, they have you in, you know, kind of a strategy, investment strategy that matches your risk profile, how much and how much growth you want to get out of it. So they're trying to create a blend of that. Above 200 to 250,000, depending upon where you are, you can often direct your investments basically in an account that you'd manage, just like if it was a private foundation. So there's options, but for, you know, smaller, you know, 10, 25, $50,000, you pretty much say, I want this to be in a growth or a moderate growth or an income kind of investment strategy, and they take care of that from there. So we had a question from the field. Does the donor have any control over investments by the management entity? And that's basically it. It depends upon how much is there. And in all honesty, the rules differ from entity to entity. So that's something when you're determining where do I want to do a donor advised fund that you'd want to investigate. If you want more control, that's a good question to ask. Some community foundations may not have the infrastructure that, you know, one of these really large, you know, for-profit custodians has, and they may have a little less flexibility, but they may have really good systems and they might have more. So it's really, you know, an entity to entity difference there. Right. So that gives an idea of the simplicity and the ease of which you can work with the donor advised fund. You know, clearly Kathie spelled out a lot of the complexities and challenges, and which, you know, a lot of people really embrace of a private foundation. Maybe let's dive into that now a little and talk about, okay, let's look at the management day-to-day of a private foundation. Jennifer, you want to start us down that path?
Yeah, and maybe before we do that, one other question is there some type of threshold, you know, if someone wants to start with 500,000, because there are so many, a little bit extra administrative burdens with a private foundation, is there kind of a threshold that you would advise that somebody have before they started a private foundation and, you know, they went more of the donor advised fund route?
You want me to answer?
Sure.
That's a really interesting question, because we have a lot of people who have private foundations who do not have a huge threshold. I think the New York Times has suggested that 5 million is the threshold, but we have one client who set up a private foundation just because they were having a difficult time telling all of their friends who served on charitable boards no. And so they have a private foundation. They put $10,000 or $20,000 into it each year. They make the donations that they want. And when their friends come asking for donations, they have a really nice letter that says, thank you so much for your request. We think that your charity is absolutely wonderful. But we make all of our contributions through our foundation, and unfortunately, our funds are expended for this year. So I think it just depends on what people want. But you do, just filing the 990 PF is an expense each year. So
Correct.
you know, you do have to factor that in, but I don't know that there really is a threshold amount.
Yeah. Thanks, Kathie. Yeah, so as you know, as Mike mentioned, really with the ease of the donor advised fund, there are some things with a private foundation that, you know, takes some attention throughout the year. As we've talked about filing an annual tax return, there are, you know, an annual tax return has to be filed throughout the year because you are paying that excise tax of 1.39% on your net investment income, so your interest, your dividends, and everything the foundation's receiving. There's quarterly estimated tax payments that have to be made, and so monitored, paying those online. Again, the rate is small, but it does have to be something that's handled throughout the year. An annual tax return needs to be filed. And typically, depending upon the state, usually a copy has to be sent to the Attorney General's office. Other states have different registration rules depending upon if you're soliciting funds for the private foundation in that state. And then we have that unrelated business income tax, which is a 990T that you file. So if your foundation invests in certain investments that throw off a K-1, you might have some ordinary income to be considered as unrelated business income, and a tax return is then filed. The tax rates on the unrelated business income is typically the corporate tax rate. If there's other types of, as Kathie mentioned, you know, oil and gas or some type of royalty working interest, you could have unrelated business income taxes. There's also, as we have alluded to, annual giving requirements of the 5%. Typically you have about 24 months. So if you had $1 million you had to give out of your foundation in 2020, you would have till the end of 2021 to pay those grants out for charitable purposes. But it is something that you do have to monitor and watch. There are steep penalties for not distributing your required minimum distributions. So it makes it's actually kind of helpful to kind of watch that throughout the year so your board can have a plan for what types of grants they're going to give out and the amounts. But it is, again, something that has to be watched. The other thing, we get a lot of questions on this, is there's certain types of grants that can be a little bit of a challenge. If your foundation is paying for seats at events, which I know is not happening as much this year, but a lot of times, you know, you'll sponsor an event for $10,000 and you'll be getting a table, or people will want to do auction items at the event. You have to be really careful out of a foundation because you don't want any kind of benefit that could be considered self-dealing. So if the foundation wants to sponsor an event, we typically recommend that the table at the event get donated back to the charity, so there's no type of benefit coming back. But it's just something to watch, that you're not, you know, you're not buying auction items and events where there is benefit. There are some times where it makes sense if your trustees or board of directors are having to be on site to visit programs. There's certain things that may allow for it, but overall we try to keep anything that would be a personal or any kind of goods or services coming out separate and out of the foundation. Another question that we get a lot out of private foundations are, can we just make grants to individuals? I actually received this question quite a bit this year with COVID and just the significant need across our state and our country. And there are times where a private foundation can give grants to individuals. However, most of the time that has to be pre-approved by the IRS. So when a private foundation is set up and you're getting your exempt organization grant from the IRS, you can request and document out how that individual grant process is going to go. What does the application look like? Who can receive it? But it does have to be pre-approved. There are times for emergency grants that you can, without pre-approval, sometimes certain scholarships or emergency situations where you can give without pre-approval, but it does require a lot of documentation, I's dotted, T's crossed, to make sure we've got everything in the file so you can make those. Otherwise, there can be excise taxes on expenditures that aren't used for charitable purposes. The other thing is, if you want to donate to an organization for charity, but they're not a 501c3, you can do that out of private foundation. However, as Kathie had kind of alluded to before, it's called, what you have to do is you have to monitor those expenditures and how those funds are used and tracked. So a lot of times, whoever you give those funds for will have to provide a report back to the foundation of how those funds were spent, how they were spent for charitable. And so there's just different reporting requirements. The other thing, as Kathie mentioned, there's some things, to avoid the excess business holding. So between your trustees or board of directors in the foundation, you can't have large holdings in different businesses. So that's just some of the annual requirements that we kind of watch and look for when you're managing a private foundation. And I don't know, Kathie, if you had anything else to add onto that.
No, I like the way you sort of filled in my gaps, so thank you.
So besides just the day-to-day tax, there's also, what do you do with the funds? Mike mentioned what you do with the funds in a donor-advised funds, but really, how do you invest those funds in a private foundation?
Well, and I think the start of the conversation there is, kind of what is your time frame for giving, and what's the pace you want to give at? Is it, I want it to be in perpetuity? I want to, just stick to the 5%, so you're trying to develop a blend that takes that, what I call pace and time frame, with, growth outlook or expectations and your risk profile. And you kind of blend those together, and you're going to develop what we'd call an investment policy statement. Right. That is basically a guide for how a prudent investor would approach given those parameters. And that just creates some boundaries so that, you're living within the kind of guidelines you've set up that are the rules for our foundation. From there, it's a basic investment account, and you're going to look at, the right asset allocation. Of course, you're going to want to avoid some of the problematic investments that Jennifer and Kathie have shared with us. But you want something that's going to allow you to fuel that 5% giving, hopefully in a way that is allowing the, foundation, corpus or principal to continue to grow, while you're giving, and allow you to have more and more impact out of that. A couple things to keep in mind in the investment. You don't necessarily always think that the investment and the giving portion overlap. But, Jennifer did talk about, there is I guess it's 1.39%, net investment tax now. And if you have securities, if they're appreciated securities, and you're given a gift that's substantial enough, you can give those shares and give that directly to the charity, because they're likely not going to be subject to that same tax when they sell it. So you've saved that little bit of tax. So there's creative ways of giving that you can help manage by looking at what assets you're holding in the foundation's account. The other thing is just, making sure there's good coordination for the timing of your gifts, right, with the availability of resources. If you're going to be given cash, if you're managing it yourself, better have a conversation with yourself and say, self, we need to generate some cash here. If you're working with an advisor like us, we have that conversation several times a year. End of the year, Christmas, Thanksgiving holiday, Giving Tuesday, we know those tend to be heavier giving times. And so we're having a conversation leading up to this to make sure that the right resources are in place, to make sure that those pledges for gifts are taken care of. But again, it's really pretty straightforward And it's not hard, particularly if you've got some help. You just need to set the guidelines, kind of live to those guidelines, and then make sure they mesh with your giving patterns. The thing we haven't touched on a lot here, and hopefully it comes through, because I know that Kathie and Jennifer and I all really embrace this and love working in this part of our field in particular, because you get such joy out of getting to work with people who are in this mode of, you know, giving from their own, from their blessings. And, you know, so while we talk about a lot of the challenges and the roadblocks, there's a whole lot of fun involved in this.
Yes.
I mean, you know, yes, you've got to be careful that you don't take a wrong turn, but boy, you get to go talk to a lot of great charities, and you get to do the due diligence and vet, is that somewhere I'd like to give? You don't have to have quite that level of discernment in a donor advised fund, but you know, this whole concept of giving, however you choose to do it, opens you up to conversations about, you know, different elements of, you know, social, human, you know, whatever type of needs are out there that just make us, you know, better and fuller people. And I think that's why we all like working in this and working with the people who are, you know, embracing these concepts and are just looking for the right way to do it.
Mike, one question that we get a lot is, what type of assets can you actually contribute? Is it just cash that you can put into a donor advised fund in a foundation? Or is there other type of assets? I mean, I got a few questions this week. You know, can I put my artwork and donate it to my foundation and it hang in my house? Can I put, you know, some piece of my business into a donor advised fund or a foundation? I mean, I know that comes up a lot as people are going through tax planning, and so maybe we can take a few minutes to address some of those questions.
Well, you would start with artwork. So that one is probably your most problematic area, where you're going to have to be careful. You know, giving your artwork to your foundation and hanging it on your office wall behind you probably isn't going to fit into those prudent investor kind of giver guidelines that are going to be well accepted. But if there was artwork and you wanted it to hang somewhere else, there's probably ways to work within that. Right. As far as other assets, I mean, clearly we work with a lot of our clients, and when they have highly appreciated securities, that's a great gift or a great asset to contribute to a charitable organization, because they're not having to pay any capital gains personally. So don't sell it to generate the cash to give the security, because then there's no capital gains paid on that part of it. And the charitable organization gets full benefit of the value, or at least 98.5% of the full value of it. So that's an easy one. I mean, marketable securities are an easy one to transfer over. That way you don't have to sell. It's just easy to do. You can get into more complex assets. And I think if we, you know, think back to the slide you were showing earlier, there's just different ways for valuing complex assets and what the thresholds are to which they can be deducted. So you've got to be careful about, is it contributed at book value? Is it contributed at market value? And is it at what percentage of your AGI is it deductible? So pretty much anything conceivably could be donated as long as it has value in a market. You guys got anything you want to add to that one?
You know, this is going back to a comment you made earlier, Mike, about your pledges. And I think that that's a caution, because if I, as Kathie Coyle, make a pledge to XYZ charity, and I have my private foundation pay for it, or I have my donor advised fund pay for it, that's considered self-dealing. There are people who are trying to get those laws changed a little bit, but I don't believe that's happened. So if you're going to make a pledge to a charity, you should make it from your private foundation. Have the private foundation make the pledge instead of having you personally make the pledge.
And I think that brings up another point that you've got to come up with a true value
Right.
for any asset, a complex asset, art, whatever it is that you're contributing. Marketable securities tend to be pretty straightforward because there's a market for that. But if you were contributing shares of a private company, or basically anything like that,
Mhm.
an appraisal of sorts is going to be required, and there's a process for which you go through that your tax advisor and attorney and other advisors will help you through. But definitely you've got to find a fair value for those that the IRS will find acceptable as well.
Correct.
One other question we get on occasion, one of you may want to, is what's your ability to move resources between a donor advised fund and a foundation?
I was gonna say we've had this come up quite a bit. Kathie, you can take.
Well, you're welcome to as well. I mean, a private foundation may not get a qualifying distribution for
Correct.
making a donation to a private foundation, to a donor advised fund, but it is perfectly acceptable for a private foundation that is what the terminology is sunsetting, which really means we're done with this private foundation. And it's okay for a private foundation to sunset into a donor advised fund.
So the only time you would do it is when you're in the process of closing down shop.
Correct.
Correct. The IRS, as Kathie, alluded to, the old history is they really wanted those foundation funds to be used out in the charitable streams, and not going from a private foundation to a donor advised fund where then there's no required time to distribute those assets. They really wanted those funds to be used.
And there is movement actually both at certain states like New York and Minnesota, and then there's some talk, even in federal legislation, to require donor advised funds to make at least the same distribution each year as is required from a private foundation. Now, the statistics that I've seen on donor advised funds who are definitely pushing back against this say that if you take the total funds that we have, we contribute 20% annually. Now that may be that Mark Zuckerberg's billions get put onto, someone else's, $5,000 account, but it's interesting. And, I mean, the press has a lot of stuff on this. There are always articles in the Wall Street Journal about what should be happening with donor advised funds and what the donor advised funds think should be happening. And as I say, a lot of clients have both a private foundation and a donor advised fund. Another benefit of the donor advised fund, and again, there's legislation that sort of impacted this, is that if you make a donation to a public charity, a donor advised fund counts as public support to keep a public charity from tipping into private foundation status, which is sort of a little bit more complicated than we were going to get into today, but there really are benefits of both sides.
Right.
Have you seen an increase in use of donor advised funds and private foundations over the last several years with some of the changes in tax law? And what are some of the practices that have been put in place as a result of that?
More people I see more people doing donor advised funds.
Yeah, I've seen that as well from just an income tax perspective. When the standard deduction increased quite a bit, a lot of individuals were doing some planning where they were choosing to bunch their charitable donations. So they might put a couple years worth of donations and make one large contribution to a donor advised fund, and then take, a big deduction on their income tax return that year, and then over the next few years they'll choose to take the standard deduction and then pay out all of their normal annual contributions out of their donor advised fund. So I would say we've seen quite a bit of that in recent years from the tax law changes. And with the donor advised fund, there's really not a minimum. So someone can put 20,000 or 50,000 in there, and because of the ease of it, it just makes it more available.
I think that's an example of where this is a perfect blend of being a good steward for our society and humankind, as well as being able to be responsible for, just the fiscal part of our lives.
Right.
And okay, these are the rules, here's how we can do it, and I can help my community in this way and still get some advantage of it.
Mhm.
Doesn't demean the value you're giving. It just says you understand, the rules of the game.
Right.
I've also seen people donating to some of the donor advised funds who set up special funds for COVID relief too. And so I think a lot of the donations this year, might have gone to that instead of to some of their traditional beneficiaries.
Agreed. I don't see any further questions coming through on here. We'll give everybody a minute in case anybody has any additional questions. But we wanted to thank you all for attending. And if there are questions that come up once this webinar is completed, feel free to reach out to any of us, and we'd be happy to walk you all through some additional questions that you may have. Anybody else have, Kathie or Mike?
I would just say this is a great place to explore, but it's also a very good place. You want to have a good advisor. And I know that's self-serving, us saying that, but you've just seen people stumble unnecessarily, and a conversation that may lead you to a donor advised fund is great. But a conversation that leads you to believe that a private foundation of whatever form is right for you too. It's just good to have good counsel to help you.
Yes.
I would echo that, because it's so much easier to start out correctly than to start out wrong and then try to correct it, because sometimes you run into tax penalties that are really severe, and you just don't want that to happen.
Right.
No.
Thank you all so much for joining, and thank you, Kathie, for joining Mike and I. We really appreciate your time and all of your expertise and knowledge that you're always willing to share with us.
It's my pleasure. I love talking about private foundations and charities. So thank you.
Have a good day.
Thank you.